A man I know, let us call him Marcus, did what everybody says a responsible investor is supposed to do. He kept buying the S&P 500 every month. No drama, no market timing, no hot stock tips, no panic selling, no trying to outsmart anybody. Started around 2000 and kept going through 2009. When he looked up after roughly 9 years of discipline, he had about $47,000 more than he had put in 9 years. That number is what bothered him. Not because he had lost everything, not because he had made some crazy mistake. What bothered him was that the result felt emotionally wrong. He had followed the advice, stayed the course, and done the mature thing. And yet the payoff felt far smaller than the story he had been sold about long-term index investing. That is the part most people are not prepared for. You can do everything right and still spend a decade barely moving if your whole strategy rests on one market, one sequence, one country, one kind of optimism, and one assumption about how compounding shows up in real life. That is why I want to say something that will sound almost wrong the first time you hear it. The S&P 500, the thing almost every financial guru on earth tells ordinary people is the safe, sensible, responsible default, can be one of the most dangerous ways to build wealth if it is the only thing you own. Read that again. I did not say the S&P 500 is bad. I did not say America is finished. I did not say broad index investing is foolish. I said it becomes dangerous when it is the only pillar you are standing on. That distinction matters because most investors do not get hurt by average returns. They get hurt by sequence. They get hurt by the order in which returns arrive. They get hurt by the timing of crashes relative to when they need the money, when they lose confidence, when they retire, when they stop earning, when they finally need the portfolio to serve them, instead of the other way around. And if you do not understand that, then you do not really understand risk. Average return is a beautiful number in a spreadsheet. Sequence is what decides whether a human being actually gets rich. That is the trap. Now let me explain the trap in the plainest way I can. From 2000 through 2010, the S&P 500 delivered what people now call the lost decade. Roughly speaking, total return over that stretch was negative annualized. It was essentially flat to slightly down, depending on how you measure it. The exact decimal does not matter as much as what it meant in real life. A decade. Gone. Not one ugly year. A decade. And inside that decade, you got two enormous blows. First, the dot-com collapse. Then, after the market clawed part of the way back, the financial crisis. Two separate moments where the portfolio gets cut apart while the investor is being told to remain calm and trust the process. If you retired at the start of 2000, you did not experience the S&P 500 as an elegant long-run compounding engine. You experienced it as a machine that cut your wealth badly, began healing, then cut it again. That is what sequence risk feels like in real life. Not abstract, not statistical, personal. Your timing relative to the crash matters more than the long-run average return. Everybody quotes once the dust has settled. That is why I call it the sequence trap. When returns arrive in the wrong order, average performance can tell a beautiful story while your lived outcome tells a brutal one. And the reason I keep coming back to that lost decade is not because I think history repeats neatly. It does not. It is because most people have never emotionally absorbed what it means to do the responsible thing for 10 years and still have almost nothing to show for it, except patience. That is a very different experience from the charts people use to market index investing. Now let me make this even more uncomfortable. We are in 2026. The United States market has been living at very elevated valuations. AI enthusiasm is everywhere. Narratives are stretched, expectations are big, and while I am not interested in pretending I know when the next crash begins, I do know this. If your entire portfolio is 100% American equities and nothing else, then you are always one bad decade away from learning the sequence trap the hard way. That is the issue. Not that the S&P 500 never works. It often works magnificently. The issue is that if it is your only exposure, your whole financial life is hostage to the moment the cycle turns. And when people tell me that owning only the S&P 500 is enough because the average return is good enough, I know immediately they are talking like someone who has not felt sequence risk in the part of life where it matters. So how do you fix it? You do not fix it by abandoning broad U.S. equities. That would be silly. The S&P 500 and broader American equity exposure generally still deserve a central place in a serious portfolio. But central is not the same thing as solitary. What you need is structure, you need layers, you need assets that do different jobs so that your portfolio is not a one-note bet masquerading as prudence. I think of it as a fortress portfolio, 5 pillars, 5 jobs, 5 non-overlapping roles. Each pillar exists because the S&P 500 by itself leaves a structural gap. And once you understand what that gap is, you stop building portfolios like an optimist and start building them like an adult. The first pillar is the bedrock. This is still the core of the whole enterprise, broad U.S. equity. American business ownership, the engine of long-term growth. This is where something like 40 to 50% of the portfolio can reasonably live if you are building around this philosophy. Now, there are really three serious ways I would think about this bedrock. The broadest American version is VTI, the total stock market, not just the 500 giants. Everything, the mega cap leaders, yes, but also smaller firms, mid-sized businesses, regional players, entire layers of corporate America that do not make the nightly headlines, but still participate in the economy. The slightly narrower version is VU, the classic S&P 500 approach. You own the large companies, the dominant franchises, the firms that define American equity exposure for most investors. It is cheaper than almost anything active. It is efficient, it is straightforward. And over the last decade, it has been a magnificent ride because mega-cap technology has dominated so much of the market's gains. Then there is VT, the total world variant, for someone who wants global equity ownership embedded into the foundation itself, rather than added later as a separate layer. Now, if you ask me what the bedrock is supposed to do, the answer is simple. It is not supposed to be exciting, it is supposed to work. This is where I do not want people getting clever. Pick one broad low-cost equity base and move on. The interesting decisions should happen in the other pillars. The bedrock is where you stop trying to prove that you are imaginative. That said, bedrock alone is not enough. Why? Because a pure growth portfolio has a hidden weakness. You only really benefit when you sell. That sounds fine in a bull market. It sounds fine when prices are climbing and everyone feels intelligent. But if you need money during a flat or falling market, the absence of internal cash flow becomes a serious problem. You are forced to sell into weakness. That is why the second pillar matters. The cash flow engine, roughly 20% of the portfolio. This is where dividend-focused ETFs begin doing a very different job from the broad market. People are often dismissive of dividend strategies because they think everything comes down to total return. And in a neat classroom sense, they are not entirely wrong. But in actual life, cash flow changes behavior. If a portfolio throws off meaningful income every quarter, then in a flat or ugly market, you do not have to carve off the body of the portfolio as aggressively just to live. You are not always selling seed corn to eat dinner. That matters more than people think. Seiji is a very good example of this kind of cash flow engine. It forces a certain quality threshold into the portfolio. Long dividend history, strong cash flow, sound balance sheets, companies that can pay and keep paying. It yields more meaningfully than a broad growth heavy index. And in a lost decade type environment, that quarterly income is not just a statistic. It is a psychological stabilizer. Then there is VIG, lower yield, more growth orientation, focused on businesses that consistently raise dividends over time. That is a subtly different kind of quality screen, less immediate income, more emphasis on the discipline and resilience of the companies themselves. DGRO sits somewhere in between, broader, more middle ground, neither as yield, heavy as SHEED, nor as growth, biased as VIG. I am less interested in declaring one of these morally superior than I am in making sure the investor understands the job. This pillar is not there to replace the bedrock. It is there to make the portfolio less dependent on selling. That is a different function. When you are still working, fine, reinvest every dividend and let it compound, but later when markets go sideways or ugly, this internal cash flow becomes the difference between patience and forced liquidation. That is why I say the bedrock grows. But the cash flow engine pays, and the moment you understand that those are different jobs, the structure starts making more sense. Now we come to pillar 3, and this is the one that makes a lot of people uncomfortable the first time they hear it. The shield, 5 to 10%. Gold, I know exactly what a lot of people think when they hear that word. They think superstition, they think relic, they think dead metal, they think Buffett hates gold. Yes, I have made those remarks before, and the criticism of gold as a non-productive asset is fundamentally true. Gold does not innovate, does not pay a dividend, does not build factories, does not earn profits. If you bury it and dig it up, it is still the same metal. All of that remains correct. But the problem with simplistic dismissals is that they sometimes ignore function. Gold is not there to be a business. Gold is there to be insurance. Governments print money, always have the temptation to always will. That means the purchasing power of paper claims is never as sacred as people pretend when they are feeling calm. And when real financial stress hits, when confidence in currencies or policies starts fraying, gold often behaves very differently from stocks. That is why central banks own it. That is why wealthy families quietly keep exposure to it. Not because they think it is a wonderful compounding asset, because they understand what it protects against. In a true crisis, the point of the shield is not to be glamorous. The point is to keep going up when the other parts of the fortress are taking fire. Now, if I wanted paper exposure to gold, I would care deeply about costs. That is why I would not automatically default to the most famous fund if a cheaper and cleaner one does the same job. Something like IAU is already better than many investors realize because the fee drag is lower. SCOL can be even more attractive for someone who wants physical allocation and a lower expense ratio than the older. More famous alternatives, again, the details matter less than the role. This pillar is not there because you are betting that gold becomes the future of civilization. It is there because sometimes the thing that does nothing in good times does exactly what you need in bad times. That is not romance. That is engineering. Now, once you add a shield, the portfolio gets safer in one dimension, but it still remains too dependent on one country unless you fix the next problem. That is Pillar 4, the escape hatch, roughly 10 to 15%. This is where I think home country bias blinds a great many investors. If you live in America, you naturally assume America should dominate your portfolio. The last 15 years made that bias look brilliant. Big tech dominated, the U.S. outperformed. Foreign markets looked boring, cheap for a reason, or simply unnecessary. But history does not move in straight lines. Japan once looked unstoppable. Its market then fell apart for decades. Emerging markets had stretches where they crushed us returns, while American investors sat through long, flat periods. Valuation cycles matter. National dominance changes, market leadership rotates. So when I look at international equities trading at far lower valuations than the U.S. market, I do not treat that as automatic proof they will outperform tomorrow. But I do see an opportunity to own earnings elsewhere at a much less demanding price. VIX's is the broad global X's answer. Thousands of companies outside America, Taiwan, Semiconductor, Toyota, Nestle, entire productive systems that American investors often ignore while claiming to want diversification. VIA strips out some of the more volatile emerging market exposure and focuses on developed economies, cleaner, calmer, more familiar for people who want foreign diversification without taking on every geopolitical tail risk at once. Then there is VWO if you want emerging markets directly and are willing to accept the volatility that comes with faster growing but less stable regions. Again, the point is not to bet against America. The point is to acknowledge that no single national market should have the power to decide your entire financial fate. That is what the escape hatch is for. If the U.S. enters its own lost decade, you do not want every dollar in your life to be trapped inside that sequence. You want a door. That is what international exposure gives you. Now we come to the fifth pillar, and this one is the most fun, which is exactly why it must remain the smallest, the rocket 10% or thereabouts. This is not the part of the portfolio that protects your sleep. This is the part that can change your retirement date if the thesis is right. Now, if the great technological build-out of this era really is centered on semiconductors, AI infrastructure, compute power, and the monopolies that harness all of that capability, then some portion of the portfolio should be allowed to participate directly in that upside. But I want to say this plainly. This pillar is dynamite. Not because it is bad, because it is concentrated. SMH gives you exactly what it sounds like. Very direct semiconductor exposure, a real bet on the picks and shovels of the AI build-out. NVIDIA, Taiwan Semiconductor, major chip names, the places where the upside could be violent if the thesis continues working. SOX gives similar exposure, but with a somewhat different composition and a slightly different spread of names. QQQM is a more tempered version of the same ambition. It still gives you big technology, still gives you AI. Adjacent winners still gives you the dominant non-financial NASDAQ names, but with a wider set of cash, generating businesses around the chip story itself. It is a little less pure, a little less explosive, a little more forgiving. If the chip cycle gets ugly, that is what I want people to understand. The rocket is not there to rescue a bad portfolio. It is there to add controlled aggression to a strong portfolio. You do not put your emergency fund here. You do not pretend this is safe. You do not talk yourself into believing concentration is the same thing as courage. You simply acknowledge that there are moments in history when a small aggressive allocation sized honestly can matter a great deal over 20 years. Now let us bring the whole thing together. The Fortress portfolio is not trying to beat the market every year. That is not the point. It is trying to avoid being destroyed by the one weakness that pure SP 500 investors never really address until it is too late. Sequence timing, the bad decade, the stretch where average long-term returns still look fine if you start the chart in the right place. But your actual wealth building journey becomes stalled, flat, or psychologically unbearable because you needed the money at the wrong moment. So what do we have around half the portfolio in the bedrock? Something like VTI or VOU or VT, if that is how you prefer to frame the global base. About 20% in a dividend engine such as SGD, VIG, or DGRO, so the portfolio has internal cash flow and does not depend entirely on selling shares in bad markets. 5 to 10% in a shield like SGOL or IAU, so inflation shocks and financial fear do not hit the entire portfolio in the same way at the same time. 10 to 15% in an international escape hatch such as VEXUS or VIA, so you are not fully trapped inside a single national cycle. And around 10% in a rocket like SMH, SOXX, or QQM, so the portfolio still has the ability to benefit directly from transformative technological upside. Now ask yourself what has happened here. You still own American capitalism, you still own growth, you still own the giant productive machine, but you no longer depend on one story. That is the change. You have added cash flow, you have added protection, you have added geographic diversification, you have added controlled upside, you have stopped behaving like a man who thinks one market can never betray him. That is what maturity looks like in investing. Not abandoning risk, structuring it. And I want to end where I began, because Marcus matters more than people think. His mistake was not that he bought the SP 500. His mistake was that he believed broad U.S. equity ownership by itself was enough structure for a whole financial life. It is not. It is a magnificent foundation. It is not a fortress. And if you do not build the rest, you may one day discover that doing everything right still leaves you stuck in the wrong decade with the wrong sequence, and with far less growth than the spreadsheets promised. That is what I want investors to avoid. Not America, not stocks, not growth, the trap. And once you see that trap clearly, you stop asking whether the SP 500 is good or bad. You start asking a much better question. What is missing if it is the only thing I own? That is the question that builds better portfolios. That is the question that keeps compounding alive when the sequence turns ugly. And in the end, that is the question that turns an index investor into an actual allocator of capital, rather than just a believer in one story.